Hey, good morning, everybody. It is Tuesday. So, Tim and Tim, we're back. And it's a very interesting day today. Well, because it's the day after Halloween. So, Tim, how was your Halloween? Did you get all the Reese's cups?
You know what? This was the first Halloween where we didn't hand out candy, and my daughter went and hung out with some friends at their house, and my wife and I turned off the lights on the outside of the house and watched a movie.
Nice. We actually watched Coco last night because we had already
Oh yeah,
watched Hocus Pocus. Yeah,
we
at my parents' house last weekend.
we watched the greatest beer run ever.
Mm, how was that, by the way? I've seen some commercials and stuff, like ads floating around on YouTube about it.
Well, my wife is a little disappointed about Zac Efron with a mustache. She's not a mustache fan. But other than that, it was actually a pretty good movie.
Was it?
Um,
Oh, I'll have to add it to the list then.
Yeah, especially when you realize like it's based on a true story and I'm sure they embellished some things, but this guy actually did
Right.
some of this. It's like that's kind of nuts.
Right,
Uh,
right. Well, good. Well, hey, this week the Fed is meeting today. There's a lot of tweets going around on Twitter about is it going to be 25 basis points, 50, 75? I think, the likelihood, a lot of stuff even floating around on LinkedIn, it's like, most people are kind of expecting a 75 bips increase to the rate today. Just curious, Tim, what do you think is going to happen?
I think my head says 75, my heart's saying 50.
The optimistic in you?
Well, I mean, you are seeing some signs, right?
Yeah,
You're starting to see some signs that the 10-year Treasury and rates aren't aligning. I forgot what I saw. The factor I saw about how far off those are.
oh, let me check
Um,
what the 10-year treasury is right now.
but then, some other things seem to be inflation seems to be easing a bit. Some of the things that they were looking for in terms of signs are there. And then you got a lot of the experts out there saying that like the leading indicators are actually lagging a bit. So um,
Mm.
they're like, hey, why go out and be that aggressive with it when it seems like what you've done has been effective. Let's see where we are before we just go crank this thing. But
That's a lot of sentiment I have towards that too. Is the 10-year treasury bond right now is just over four. It's like 4% flat right now, and ultimately, I think what they have done has been effective with slowing the rate of inflation. I think last month over month, inflation stayed flat. If anything, it increased like 0.1% or something. It was very, very, very small. So ultimately, the inflation rate is a lag indicator, which is controlled by the interest rates. So I feel like ideally, I would hope that they don't do anything. I don't know what's going on with the election coming up next week. If they're, potentially not going to raise it this time because they want voting at the polls to be positive. But I mean, do you think that if they increase rates again, will the voting at the polls be negative? And there's always arguments both sides, and people always want their side to win or whatever. But you know, ultimately, like, how does all of this kind of stuff affect our business as commercial real estate investors?
yeah, so I mean, you're starting to see a lot of signs. Like if you paid attention, you noticed how big of a factor the housing costs and rents and things like that were in the total inflation number.
Yeah.
It was a big chunk of it. Um, so you're starting to see that ease definitely in the housing side. In some markets, single family home prices are actually coming down about. I think I saw something about 1.2% in the Austin market recently, that they've come down. You're starting to see that out in California, and traditionally, the East Coast trails the West Coast on those kind of things by at least 3 to 4 months. So if you start to see it out there, there's a good chance that you're going to see it from the East Coast, 3 to 4 months later. Um, Not always, but it's a pretty good indicator. Um, so I guess what I would say is, me personally, I'm starting to see some things in at least the single family space, that you didn't see, quite some time. I have houses in my neighborhood that have been on the market for 60 plus days.
Hmm.
That's been unheard of in the last 2 years, right?
Yep. Yep.
Um, I don't, and here's the thing, guys. I don't necessarily think this is a bad thing, um, as far as real estate goes. I think there needed to be a little bit of a level set in terms of real estate. Um, I think I think it's going to make things a lot more positive for investors and buyers moving forward. Um, and I think it's going to kind of put some. I think it's going to bring some reality back to the real estate market. Which again, guys, I do not think is a bad thing. If you look, Tim and I are closing on stuff left and right, and there's a reason for that. It's because I believe in it. I see a lot of upside, and I don't tend to look at real estate as something I'm trying to get in and out of in 5 months. Um, I'm looking at things as 3, 4, 5, 10-year holds, and I completely believe in it over that amount of time. I think right now we just needed a little bit of a reset, and that's kind of what's taken place. Now, I also want the Fed to be cognizant of the reset that's in place and not to overshoot the mark and just completely kill things, which is why I'm kind of pushing for more of a half a point rather than 75. So
I think too the sentiment that would come across, the nation, you could say, is if they don't raise it 3/4 of a point or 75 basis points, and they do only raise it 25 or 50 bips instead, is it's a sign of a light at the end of the tunnel almost,
mhm,
where it could generate some ease in the market and concerns around what's going to happen over the next 24 months if we start to see a reduction in those rate increases. People might have the sentiment, hey, actually things are getting better, and they directly tie the rate increases to how the market is going to be doing. And it is weird. I have been watching the housing market in the Wilmington area because we're renting right now, and we have started to see some price reductions, but I don't follow it closely enough to just know if those price reductions are because sellers are asking more reasonable prices, or are they pulling back the prices because there's actually not enough buyers out there and there's no activity, right? Because
mhm,
some people were just throwing stuff on the market to see what they could get. And if they got the number, like, cool, I'll sell it, right? But I think now it's at the point now where people are actually listing stuff for what it's worth. And I do agree. I think that the housing market, in commercial and in residential, needed some kind of plateau or leveling point because the cost of housing has just gotten so expensive and rentership is going to continue to rise, that they really need a plateau period of time for wages and salaries and savings to keep up. I mean, to kind of catch up to where the new housing prices have stabilized. Because other than them coming out with like a 40-year amortization loan instead of the 30-year fixed loan, it's the only way to make these more expensive houses more affordable. They just really ultimately at the end of the day need some more time.
yeah, yeah, and Facebook user, I would I agree with you, and I would also add to that. It's time to just honestly, guys, I don't think it's a bad time to be buying single family houses if you have a long term view. If you can make them work at the current interest rates, I don't think it's a bad time. And part of the reason I say that is that there's a lack of supply. There's a
Hmm.
total lack of supply. We're already at a deficit. Builders are holding off right now. New starts are down. Um, and part of that's the cost. The other part is the interest rates. The other part of that is the lack of buyers out there for them right now. So, but that doesn't change the population in this country, right? So
That's
there's
right.
still a demand for it, and there is going to be a demand for it as soon as things change a little bit. And if you're out there kind of gathering it up at the moment, when people do come back and want to demand it, well, you're going to have the supply. Um, so that's one of the reasons we're doing some of the stuff we're doing. Trying to buy groups of single families at the same time.
Yeah,
That's not a
I get it. I get why like hedge funds and like big institutional money, they like build to rent communities. I get it now.
Yeah, 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 100%. And that's another reason, guys, why land is such a hot commodity right now. People are stockpiling land because when the builders are ready to build,
No, they're not
you
making any more of it.
yeah, you're going to own the supply.
Yeah, that's right.
So
And
this is a
buying in
really
good markets, obviously, don't
yeah,
forget your market indicators where you have to pay attention to population growth, migration growth, the overall demographics of the area. Are jobs moving in or out of the area? Is the city, growing or expanding? All of those things also come into consideration. So, if you're in a tertiary market with a declining population, I probably would tell you don't buy anything right now. Like, wait a while to see how far things are going to go down. But if you are in one of these growth states or growth cities, buying stuff at a slight discount now, where you're marrying the price and dating the rate, you can refinance in a couple of years later. But I do think it is a good opportunity for people to come in and buy some stuff, single family houses at discounted prices over the next, I would say, 12 months. I mean, because there's a lot of adjustable rate mortgages out there that people are not going to have the debt to income ratio or the means in order to refinance into a payment that's feasible for them, because they probably over leveraged to begin with, hoping that their adjustable rate mortgage would go down as rates were going down, and then they just missed the bottom and they never refinanced. So I think that there is going to be quite of an opportunity for that. And being creative, if you could do like subject to financing and seller financing, or whatever means of creative financing that you can do. I mean, Tim and I, we've done some seller financing deals in the commercial space, and ultimately, like, the sellers are understanding where the markets are, and if they want to get their price, they got to get it today, but they're going to get paid later type of sentiment.
Yeah.
So it's very interesting dynamic to see how quickly everything has changed over the last 2 years, really. Like, I mean, from the start of COVID to now, it's just been rocket ship growth. And I really don't know what to expect in the coming, 3 to 6 months of what's going to happen in the housing market. But we've already seen a decline. Everyone's talking about a decline. The news is selling the fear. And most of the population is going to be watching the news and implementing what the news is telling them is, everything's crashing and burning. So there's definitely
Yeah.
been a tightening up around investors. There's been a tightening up around investments, and people saying, "Hey, like, I'm just gonna sit here and wait for a few minutes and see what's happening." And it's not just private investors; like, institutional lenders are doing the same thing.
Yeah.
Back in the middle of the summer, they were finding any reason that they could in order to get out of a loan, just because they were unsure of what was going to happen over the next coming period. So very
Yeah.
interesting dynamic, at least from my perspective.
Yeah, I agree. I agree completely. And one little thing I wanted to say about the single family space again is I saw a couple of things today that actually kind of reiterated what we're talking about here. Is I believe in the period from 2010 to 2019, we were building at a pace similar to what we built at in the 1930s. Um, you think about the population change between then and now, and you're building at a similar rate. That's obviously speaks volumes towards how undersupplied we are, because we certainly over the last 3 years have not addressed that gap at all. Um, and the fact that we're in a time now where we're holding back again is even more concerning if you're wanting the supply to increase. And then the one other thing I would say too is remember regardless of what's going on nationally, real estate's a very area specific type of investment. So just because Austin or Phoenix may be seeing a slight decline, that doesn't mean other places are. We're not seeing it right now in the Charlotte market. Um, you know, yes, single families are sitting on the market longer. Multifamilies are still moving pretty well. Rents are still going up. We haven't seen a drop really in prices. And then a place like Winston Salem, North Carolina, for example, that does not have enough housing. Period. It's not going to see the same declines that some of the hotter markets have seen. So just keep that in mind. Do your due diligence on the market that you're looking at.
Mm.
That's one of the biggest things.
Yeah, I mean, that's, what I was saying earlier. Just like it is very local. And, if you're buying in growth markets, pay attention to that. And, obviously with growth, supply and demand, macroeconomics as a whole, they're going to drive the local housing market, right? Because housing is very local to wherever you're living, or investing, I should say. But I was just kind of looking around real quick on Google, and I found a couple different articles, one from Reuters, and there's another one from Yahoo Finance, and everyone's expecting them to raise by 75 basis points this meeting today, despite the inflation decelerating to 8.2%. Because I guess last month it was nine. No, sorry, as of June 1st, 2022, it was 9.1%, and now it is 8.2%. So it has decelerated, I guess, 1%, according to this article. And ultimately, what this article is saying is that they're expecting to do the 75 point rate basis point increase this meeting. But then what they're doing is setting the stage for a decrease at the next meeting. Now, obviously, nobody knows, right? I mean, pure speculation. You can have one article that says, yeah, they're going to continue to increase until they get to their arbitrary 2% inflation number that the Fed made up of what they think is a stable inflation number. And then there's other people that say, it should be closer to 5 or 6, 4.5, 5 to 6%. Ultimately, nobody really knows at this point in time. For my sake, I really do hope that they don't continue to beat us to death with 75% basis point increases. I hope that, with this decrease, as we were saying earlier, it's a lag indicator. So with the lag indicator saying that inflation has started to come down this last month, that they'd say, hey, let's just wait a minute, see what happens. And instead of pulling the lever harder to make it go down faster, why don't they just hold it and let it naturally occur, let it kind of work itself out instead of trying to force it, trying to regulate it, right? Ultimately, at the end
Yeah.
of the day, and I think that's what they're trying to do is have control and regulate it.
Yeah. And guys, remember at the end of the day, is business plans can shift with
Oh yeah.
markets, right? So like in the real estate world, some folks are like, are you still buying? Hey, yeah, I'm still buying. But I'm just not buying anything where I'm like going out and again trying to stretch the market. Like I'm not going and looking for anything where market rents today are 1,400, and somebody's trying to pitch me on the idea that a year from now they could be 1,550. I don't.
Oh, the old broker selling on pro forma, huh?
Yeah, and I don't. I'm just not buying that. I mean, that may be the case. We may still see some pretty big rent escalations over the next 12 to 18 months. That is completely possible. However, I'm not buying into it. I'm not assuming it. In fact, I'm kind of assuming the opposite. I'm typically assuming flat for the next 12 to 18 months.
I
And
agree with you there. And one reason, not to interrupt you, but one reason that I like what we do with the value add multifamily properties is that we underwrite to today's rents 2 years from now.
yeah,
Because it's going to take us 2 years essentially to get into all of the units, to renovate them, to fill them up with market rate rents. And we just assume that the rents today, if it's 1,400 today, that at the end of year two, 24 months from now, the rents will still be 1,400.
yeah,
You know, I don't think that that's entirely true. I mean, I think, just natural rent increases of 2 or 3% a year are inherent, like it's going to happen regardless. But I do like that when we underwrite these properties, we're saying, hey, we're just going to get market rate rent today, 2 years from now. And if
yeah.
we get anything on top of that, that's just gravy.
Yeah, completely agree. So, but keep in mind that there are other business strategies out there. Like, we just closed on some stuff in Walterboro and Georgetown, South Carolina. That's actually already exceeding our pro forma. We were very, very conservative in our pro forma. We bought in those markets because these were units that were under today's market rents. And we knew over the next 2 years, we'd have a strategy where we could get them to today's market rents over the next 18 months. And we're already overshooting that with our actuals. So that's an area where, the conservative underwriting really pays off. And then one of the other things I would say, guys, is there are things out there like voucher programs. So if you find properties that can utilize voucher programs, not necessarily a bad strategy, because you know what those are going to be. And typically those track some sort of inflationary rate as well. Um, like for instance, we had a property that is Litech in Virginia, and I believe the new rate when it came out in March or May, I believe the new rate was I think it was a 17% increase
It
over the
was
year
May,
before.
yeah. I
Yeah,
remember you calling me. You were like, "Hey, look, I just got a letter from whoever. My rates are going to go up 17%
yeah,
over this year." And he was like, "I don't even know what's going to happen over next year."
So there are times, I know people have kind of a negative connotation about some of that stuff, but there are times when those types of programs can be a really, really good thing to track and follow, especially right now. I think this is one of those times.
Yep. Yeah, there's one of the guys that we met recently. I love his business strategy with Section 8 and light tech rents and things like that because it's affordable and there's demand, and he never has vacancy. He's always 100% occupied. And back that with getting government assistance programs and people paying the rent on time. It's like, wow, that sounds like traditional real estate investing.
Yeah.
C class, working class. It's not a D, what you call it, like a war zone. It's not a war zone property or anything bad, but it's something that just sits there and makes money at the end of the day because people need the place to live. You're providing safe, clean housing. The government is backing the rents and has tax incentives and all this kind of stuff. So it is good hedge, right? I mean, not everybody, I don't think that everyone should always be investing in class A stuff. I mean, ultimately the returns really aren't there. And sure, like, yeah, invest in some class A stuff for preservation of wealth. But if you're looking for cash flow, I'd definitely say, you're definitely going to be in that C class range because it is a little bit less attractive and a little bit more of a management headache, depending on where the property is and property manager itself and how it's set up. But, it is, at the end of the day, it's risk adjusted returns, A, B, C, D classes, right? The lower you go, the higher the return, but the more the work, and vice versa the other way.
Yeah. So yeah, all good things. Completely agree with you on the C class, even into the B class realm, but definitely not definitely not some of the more luxurious stuff at the moment.
Right.
But guys, really, what the Fed's going to do is anybody's guess.
Yeah.
I guess we'll know. Guess we'll know in a few hours.
I think they
Um,
announced it tomorrow
do they?
for, yeah, I believe it was on November 2nd. They meet
Oh,
today and then they announce it tomorrow. But yeah,
yeah.
I mean, it
So
looks like everything online is even saying like, hey, yeah, like everyone's expecting 75 basis points, but then like stocks are up today. The 10-year treasury bond is up over 4%. It looks like we're likely going to have a 75 basis point increase next month, but I don't know if they're meeting again in December. Actually, let me Google that. When are they meeting again?
I think there
Um,
is one in December. Anybody online know off the top of
the
your head?
Fed meeting calendars, yeah, December 13 and 14.
Just in time
And
for the holiday season.
yeah, that's right. Yep. Yeah, because we're doing today's, which is November 1st and 2nd. So they're meeting today, announcing tomorrow. And then December, they're meeting on the 13th, announcing on the 14th. So
Yeah. So either way, guys, it's all just kind of a point in time thing. And again, real estate, guys, is a long term play. It's not typically short term. Speaking of short term, another indication that I always tend to track is I keep up with some of my old flipping buddies, and hey, those are things that are really starting to slow down as well. A lot of the flips are sitting on the market quite a bit longer now,
yep.
and those prices are coming down for
I
sure.
I've seen quite a few flippers on social media platforms saying that they're starting to sell these properties at a loss just because their holding costs have skyrocketed and the prices have come down drastically, and maybe their underwriting, they were optimistic in what they could sell the property for instead of reducing the price by a percentage or two or whatever. So it is a good indicator to watch what's happening there.
Yeah, you gotta be real smart right now with flips, guys. Like don't over renovate, but you still got to get it to a point where it's pretty much turnkey. If I'm being honest, and then the other thing too is when you're pricing, kind of people got real used to pricing high and then letting that bidding war come in as well. Well, now you almost need to price a little under where you want to be, and hope that you create attraction by the fact that you're the most reasonably priced in your area.
Yeah, good
Um,
point.
so instead of one person showing up at the highest priced property in the area, pricing a little bit under, and you get like five people, and maybe you get two or three that are interested, and you create a little bit of a bidding war, and you end up maybe where you want to be or just slightly over based on
Mhm.
that. but your pricing is critical right now. And then factor in those holding costs because it's probably going to happen.
Yeah.
Um, so yeah, I know a flip for me right down the street, and I walk by it every day, and I'm like, man, that's got to be killing them.
Right.
Because I said at the time, I was like, I really don't like their strategy. They came in, they bought something, basically cleaned up the yard, pressure washed the outside, but they didn't do a thing to the inside.
I think they're
And
calling that wholetailing. I've seen that term floating around where they're getting it at a wholesale price. They close on it, they maybe paint it and clean up the exterior and pressure wash or whatever.
yep,
Very, very, very light stuff that they can
yeah,
just pay like a handyman to come in and do. And then they're listing it back on the market for like $50,000 higher.
yeah. The problem is they're where they're listed at is right in line with some other places nearby that are completely turnkey that have been updated very nicely in the last like 2 years.
Hmm.
So they're behind and they're priced the same, and that's never a good place to be. Um, but hey, speaking of, hey, if anybody's out there this weekend, Vitaly and I are going to be down in Orlando at MM5. So if you guys are out there, make sure you say hi. Would love to meet some folks in person. Tim, when are you getting in? You getting in Friday?
Yeah, Friday afternoon, I think around 4 o'clock or something like that. But yeah, I forgot. Yeah, Friday, flying out Friday. Gosh, it's already Thursday, Tuesday.
Yeah,
Flying out Friday and leaving like Sunday afternoon or something like that. It's a kind of quick in and quick out. But basically after all day talking Saturday, screaming at people in the lobby because there's 1,000 people screaming at each
right.
other. That you're pretty much exhausted after that and over it.
Yeah,
But
so
yeah, we're gonna be down there. We'll be in the lobby. So if you want to come chat with us and talk to us about our Porsche event that's coming up, we're going to continue these conversations around raising money and how to capitalize on the down market, what we're seeing in the debt markets, and just trying to watch out for each other ultimately. So we'll be talking about that at our Porsche event and then driving Porsche 911s on the track. So that's going to be a really fun experience. That's in 18 more days. So a little over about 2.5 weeks. We're doing that event in Atlanta. So I hope you guys grab your tickets soon. I think there's like maybe 15 left. Tim, I don't know if you've updated the website since we've sold any more, but they're not going to be around much longer. So really excited to be doing this event.
yeah, so the website updates itself.
Oh,
Yeah,
look
I
at
mean
that
we're
automation.
we're trendy. Um, if automation is still trendy. Um, but yeah, guys. And another thing is, the race cars real estate event. I think you heard us say it a couple of weeks ago. One of the things that we always hear is who was doing this shit back when the market went bad last time. Well,
Oh
there's a
yeah.
guy. There's a guy going to be at the event who was doing it back then. His name's Mike Ely. Come see him. I think he'll have some good insight for everybody. And he can tell you what it was like to be buying notes in 2011 and 12.
Oh, dude. Oh my God. Yes. I'm so glad you brought that up. We were talking about that in Napa at Mike Izzo's event about buying notes and how to position yourself to buy these underperforming assets. And man, I didn't even know that that was a thing. And I just reiterates the fact of like going to masterminds and building relationships with people that have other experiences than you really open your eyes and enable you to go after and capture different opportunities in the market. Like, the age old saying is you have to pivot. When everyone's going left, you go right. And you have to understand what options are out there. And you don't know what you don't know until you start getting in these rooms and having conversations with people that have been through it before.
Yeah, and imagine that. Speaking of pivoting, going left when people are going right, Mike was buying houses, single family houses in 2011.
Yep.
Like, if you guys weren't around back then, I can tell you, most people would have looked at him like he had an eyeball in the middle of his head. Because I mean, there was a ton of them. Nobody was lending on them. And everybody was like, house prices are falling. Why would you be buying this? Well, now he's got a bunch of them, and they cash flow very, very nicely for him. And it frees him up to do all these other things. Frees him up to build Class A hotels in Sarasota, Florida. Builds him up, frees him up to go buy, multifamily and hotels and things like that. So that's why you do that kind of stuff. And I
Yeah.
think I think you're going to see that kind of opportunity coming here soon. Just like Tim was talking about, somebody was asking about buying notes recently, right? I think you're going to start to see that opportunity in the single family and the multifamily space, honestly.
Yep. Yeah, Kenny gonna be racing 911s. Gonna be super awesome. Like, I know a lot of real estate people love fancy sports cars and things like that, but I don't know of anyone that actually drives them on the track that they're designed to be used for. So I'm excited about that. And LinkedIn user, we're gonna be at the Jake and Gino MM5 event in Orlando Friday to Sunday. So if you grab your ticket, come say hi to us. Kenny, I'll send you a link to the race car event, or if you go to the Making Moves Facebook group, I just posted an update about it today, and I looked on our website, and there are now 14 in stock. So somebody just bought a ticket, and we're getting closer and closer to that event. So grab yours before they go. It's funny, most people wait till the week of the event to book it. So I mean, it's limited. We're not going to be able to make it any bigger or not. So if you want to go, just get your ticket now. And yeah, whoever Facebook user is, get in the room with people that know. Uh, we don't know everything. I openly tell people that all the time. But what I am very good at is finding people that have other experiences than I do and learning from them and being in that room to have those conversations and have those discussions in order to really learn and be well rounded and have my eyes open to different opportunities so that when the time to pivot comes, I know what options are out there in order to what to pursue and what not to pursue. And there's a million ways to make money out there, right? But knowing what my skill set is, what's going to be best for me to go after takes months and months and years of research and networking and building relationships with people so that when something does come across my plate, I know exactly who I'm going to be able to go talk to and confidently be able to close on that deal or do something with that opportunity.
Yeah, and guys, this can be opportunities you already have in front of you. For instance, I think Tim and I have 800 and some units now under our management, and I'm starting
User is Mike
to
Izzo. Thanks, Dennis.
I'm starting to learn about other things I can do with things I already own, other business strategies I can implement into properties I already have, that can increase NOI, that can increase cash flow to me, and that's all because I'm just around guys that are throwing out ideas. They're doing things differently than I typically do them, and it kind of opens up your eyes and gives you options to consider, right?
Yeah.
Um, Always. So take that coffee invitation with some guy that's been doing it longer than you. Come to an event where there's guys that have been doing it way longer than you, and then come to big events like this weekend where you can stand out in the lobby and just chat with people who have been doing it longer or may have found a new way that nobody thought of.
Yep. Yep.
It's a
Agreed.
great place to be. So
Cool. All right, everyone. Hope to see you this weekend and really hope to see you at the Porsche event. That's coming quick and I'm super excited about it. So, without further ado, come say hi to us if you see us. If not, we'll see you next Tuesday. All right. See you
all right,
later.
guys. See ya.